Other People's Money. Banks, Finance, and the Chaos of Financial Markets. By John K. Financialization. In its early stages, the aim of financial institutions was to assist individuals in obtaining the necessary funds to execute their ideas. For example, a bank would provide a baker with the capital needed to establish their own bakery. However, with the expansion of finance, the goals of finance and financial services faded away, and we became entangled in transactions that do not benefit individuals. The financial activity witnessed in trading merged with the tremendous growth in the finance sector, giving rise to the phenomenon of financialization and the leveraging of funds. Financialization is a term used to describe the development of capitalism from 1980 to the present day. The problem with financialization is that it serves the interests of banks and financial stock markets but does not significantly contribute to income levels, the growth of small businesses, or the economy as a whole. Securitization began in the 1970s when large institutions started trading an increasing number of financial instruments represented by stocks, bonds, and mutual funds. However, what pushed securitization to the edge of the abyss was the emergence of a new market based on derivative securities. Derivatives are contracts whose value is determined by the performance of other assets. Depending on the created contract, one party benefits from the increase or decrease in the price of the underlying asset, depending on the type of derivative. One such type is the credit default swap, CDS, which allows banks to protect themselves from borrowers' defaults or their failure to repay loan or mortgage payments. Derivatives resemble insurance in their performance, as the institution investing in a credit default swap undertakes to pay the bank's obligations in case of default, while the bank undertakes to compensate the institution in the end, adding interest. Perhaps these developments are what led us to the financial crisis in 2008. Many banks granted loans to unqualified individuals, and as a result, the number of defaults increased, with all institutions owing each other in one way or another, leading to a complete collapse of the system. Banks and the imbalance of interests. In the pre-financialization era, the economy experienced relative stability thanks to a financial sector built on a culture of caution and planning. Executives would invest their money in their own banks, providing them with the necessary incentive and determination to succeed while avoiding excessive risks. Working as a bank manager was considered a lifelong career, and managers had to bear the long-term consequences of their decisions. Today, however, managers make decisions knowing that their position is temporary and that someone else will bear the consequences of their actions. They often focus on earning as much money as possible during their short tenure and exiting before the alarm bells ring. This has resulted in a more volatile economy and the loss of individual savings. Restructuring the financial sector from within to outside. The economic policies currently in place create a state of division, and it is necessary to address the phenomenon of the financial sector profiting from dubious transactions at the expense of hardworking individuals. Savings, leading governments to rely on taxpayer funds to rescue their major banks. To avoid another financial crisis, we need to restore trust in the financial sector by restructuring it in a way that prevents banks and industry insiders from acting in their own self-interest at the expense of their clients' interests. This can be achieved by protecting customers' savings deposits and prohibiting banks and various financial institutions from engaging in transactions that involve those deposits. This measure would secure individual savings from any potential collapse. Additionally, it would limit banks' ability to use customers' funds as assets in payment and trading operations, while also restricting the availability of large sums of money that greedy traders often use for illicit gains and suspicious transactions. For more information, you can check out summaries of our books on our channel. Thank you for your valuable time.